In this lecture, we are going to take a closer look to the idea of fractal analysis and what it means in a conceptual form, so we can have a better understanding of its practical applications later in the course. The key to grasp the idea of fractal analysis begins by knowing what the word fractal means. We can define a fractal pattern as a pattern that repeats inside and outside itself in multiple degrees. The name of the fractal flow strategy comes from the idea that we can always observe separate market flows in different fractals, and these flows go in and out of coordination on a constant basis. To bring this idea to a more pragmatic approach, in any given timeframe, we can observe at least two market fractals. By market fractals in this case, I mean sets of highs and lows that appear to be in the same degree. This is an important observation because sometimes is not so clear in which fractal a market movement is. That's one of the reasons why we studied the subjective interpretation of price as a foundational principle. However, this problem will be explored later in the practical examples. For this lecture, we should only worry about the idea of market fractals and fractal analysis in general. To facilitate this notion, let's first define the idea of market vectors. Market vectors are the building blocks of highs and lows, and we can define them as the vector that come out of a high and end in a low or vice versa. Let's begin with a simple example. Imagine a simple upward market movement that we can call market vector. What you will notice is that this larger vector is formed by smaller vectors like you see in this conceptual example. These smaller vectors are also formed by even smaller vectors. This idea goes until the smallest market element, which is the tick or the smallest possible variation in price. This lens of fractal analysis is what creates the possibility to triangulate exact points of entry and exit in the markets by watching how different market flows interact with each other. This idea can be conceptually expressed in a more condensed way using the circle paradox. Imagine that you are looking at a two-dimensional circle from a given distance, but as you look closer, the circle begins to look like a polygon with a very large number of edges. The paradox dwells on the notion that the geometric figure is a circle and a polygon simultaneously depending on how far away we observe it. Fractal analysis is what makes it possible for us to see the edges of the market by breaking it down into its smaller components, so we can view this idea as a metaphorical magnifying glass. By being able to see the edges of the market, we can see where the market stops to reverse into the next move. This idea is a double-edged sword because it enables us to access a greater level of analysis, but it makes it a little bit more complex than what we would like. This complexity comes from the confusing nature of market flows, which are composed of market vectors that go in one direction. For example, an upward market flow is composed of higher highs and higher lows. However, within these higher highs and higher lows, we have downward movements happening in lower fractals, and even smaller upward movements happening in an even smaller fractal. These market flows often collide with each other. The job of a trader is to make the correct judgment about the strength of each market flow, and which one will dominate the next movement of the market. This is why we use the hierarchy of trading signals as a foundational principle in our trading. This is also the reason simple divergence without the more sophisticated layer of fractal analysis won't work properly. In other words, without fractal analysis, there is no real point of reference in terms of the perceived power of the signals generated by the relative strength index. However, the more complicated aspect of fractal analysis lives on the collision of market flows. The recognition of fractal divergence is relatively straightforward. We will explore the dynamic of market flows more deeply in another lecture. For now, it's important for you to grasp the overall idea of what fractal analysis means. The next step is to understand how to apply the layer of fractal analysis to the study of momentum divergence. That way we can derive two more sophisticated techniques called fractal reversal divergence and fractal hybrid divergence. These two new techniques will later give rise to another price action technique called fractal bar. In the next lecture, we will explore the fractal reversal divergence concept in greater detail.